Hello again. We're looking at Chapter 12 in Accounting 222. And Chapter 12 deals with investments. This is one of the areas that I have the most experience in as an accountant, and also one I find the most interesting. The first thing to remember here is that an investment for a company is an asset. This is where they have bought the stock or some other type of ownership interest in another company. Basically, there are three different ways one company can own another. First, the company can own up to 20% or less of another company. And hopefully you would agree with me and the accounting standard setters that if you own 0 to 20% of a company, you don't really have a significant interest. Therefore, you can't manipulate how much your investment is worth. When you rise from 20% toward 50%, and so we'll use, and I'll show you this when we get to the more detailed video, but if you think about 20, a greater than or equal to sign, X, a less than or equal to sign, and 50%, then you'll think of the next tier. So if you own 20%, but not more than 50%, we say that you exert significant influence over the company. So now we're concerned that you actually could manipulate stock price of the company by certain things you would do. Finally, if you own more than 50% of a company, we'll say that the one company has a controlling interest over the other company. So now let's break this down and unpackage it in reverse. If you have a controlling interest, if one company has a controlling interest in another company, that's thought of as a merger, and we handle it as a consolidation. And that's beyond the scope of the class. So you'll have a class sooner or later called Advanced Accounting. And in Advanced Accounting, you deal with mergers and consolidations, but we don't deal with them this semester. When there's significant influence, 20 to 50%, we use something called the equity method. And indeed, we're going to study the equity method in this chapter. If the company owns less than a 20% interest in the other company, then we have to consider three separate questions. First, we have to ask, can the company sell these securities before maturity? I mean, there are things like stocks that, don't mature, and so there's no way a company could hold a stock until maturity. So one category we could consider is the held to maturity category. And I'll tell you that that's for things like bonds, where the company promises it'll never get rid of them. And here you'll find this to be basic historical cost accounting, as we've seen with other types of assets like plant and equipment. If we have something that's a stock, we can't choose held to maturity, but then there are two other categories we could consider. We could consider available for sale category or a trading category. Now let's think stocks and bonds again. So if we have a stock, we could think two categories, available for sale or trading. If the company's in the business of selling stock, like if it's an investment company or an investment banker or something like this, then we'll call it a trading security of the firm. We'll expect them to sell the interest. If it's available for sale, the company says, well, we might sell it if the price is right, and we might not. Here, we'll recognize gains and losses, but we'll put them in the equity section rather than in the income statement. For bonds, we have two choices, and those are held to maturity or trading. So again, if we're an investment banker or an investment company and we buy bonds and we buy and sell them all the time, then if we invest in a bond, we're going to treat this as a trading security. But if we just simply are doing investments, maybe our company is in another business like landscaping and we've got some extra money and we put it in bonds, then we could choose held to maturity if indeed we promise that we'll never sell them. So more about this in the detailed video, but trading securities, we record gains and losses as the market value changes straight in the income statement. Available for sale securities, we consider market value changes and report them, but only in the equity section. And if it's held to maturity, a bond, we don't record any changes in market value. But do hone in on one last thing I said. We're not talking about cases here merely where we sell the security. Obviously that creates a realized gain or loss. But we're saying under available for sale and the trading category, in some cases we recognize gains or losses, even just from holding them, just because the market value changes. Well, more on that in the detailed discussion. Take care, and I hope you enjoyed the section.